There's major signs that the bulls are being favored in the stock market and we might be coming out of this bear market. On the other hand, there's fears of the bears from what we've experienced in the past. Is it time to turn bullish? Hang on. This is not financial nor professional advice. This video is for entertainment only. Hey everyone, welcome to my channel. I'm Stephen Fox. Michael Burry is famous for issuing dire predictions on the stock market, especially recently. In 2008, he predicted the housing crisis. And actually, his prediction of the housing crisis in 2008 was the basis for the movie The Big Short. So he had outstanding success back then. And around February 1st, when the Federal Reserve was meeting to raise interest rate, he warned, he simply said sell on Twitter, okay, which again was another dire prediction. And recently, he admits that he was wrong. And he's even congratulating this generation as the best dip buying generation since the 1920s and congratulated them. So, wow, this is a major turn in atmosphere. And the stock market action has been just outstanding lately. If any of this is useful to you, please like and subscribe because it really helps the channel. In this chart, we're looking at the price action of the S&P 500 as representative of the action of the stock market for the last week. And we can see that I have the Bollinger Bands around it. That's the expected movement of the price. And it's gone above the upper band of the Bollinger Bands, which I think represents a breakout, that this could be a bullish breakout. And the reason I do not think it's oversold is the relative strength at the bottom of the screen is 63. It's not considered oversold until it goes over 80. So I think we have the beginnings of a bullish breakout, and we're hoping that it's going to continue. I think the bullishness in the stock market in the last week was propelled by the personal consumption expenditures. It came in lower than expected. It came in at an even 5%, and it was 5.3% the month before. In November, it was 5.7%. So we see the beginnings of this inflation going down, which is good news, and maybe we'll get a pause in the interest rate. Right now, the interest rate tool is predicting about 50-50 whether it's going to be a pause or whether it's going to be a quarter of a point, a 0.25 increase in the interest rate. But I think it would probably be advisable to do a pause, simply because I think that's going to help the banks. And the bank crisis has sort of settled down, but the only thing that would disturb this whole outlook is if something came out of nowhere that one of the major financial institutions was having major trouble to the point that they had to liquidate. That's what happened in 2008. Lehman Brothers and Bear Stearns, they went out of existence. And it was just a major shock. These were major long-time firms. And if something like that happens, that changes this whole equation. And I think you have to get out of stocks at that point. But it doesn't look like that's going to happen because I think the federal government has taken extraordinary procedures to prevent that from happening, and they've put $300 billion into the banks through their discount window. and through their longer term bank term funding program, their BTFP, uh, they put over 300 billion into the banks, and I think that's shored up things quite a bit. And I think they're more or less saying they're going to back up all the deposits. They have to. They can't let the faith in the banks go down, because that'll drag everything down. This chart represents the heart of the dilemma. Since December through March, we've seen it go up 23%. Do you know that is the average of how a bear market rallies? The average is 23%, and we hit that exactly. And what's more amazing, from June until about August or so, it also went up 23%. So these are average bear market rallies. Now, I think the price action and the way it's acting now, it feels like a breakout, and it feels like a breakout from bad news. So the main thing that's going to distort this or destruct this is if a major financial institution fails. Or some extraordinary event, which you can never rule out the black swan coming out from nowhere. But for right now, what we know of, it could be a black swan, would be a major financial institution failing. But there is other good news that should take away some of our fear, in that when you look at this chart, equity gains are putting the skeptics on notice that maybe the bearishness is coming to an end. We've had two quarterly gains, the fourth quarter of 2022 and the first quarter of 2023. And we've had quarterly gains twice in a row. And out of 14 bear market cycles, that's only happened twice. So the odds are in our favor that this is a breakout. As this bear market has evolved, the large mega cap technology companies have come to be fortresses of safety. Meta, Apple, Amazon, Alphabet, Netflix, Google, Microsoft, and Nvidia are the largest of these companies, and they make up my favorite index, which is the NASDAQ 100. I love to invest in variations of the QQQs, which are the 100 largest companies on the NASDAQ. The top 6 companies, the ones that I've just listed, they make up 55% of the QQQ, the 100 largest companies on the NASDAQ. And the others are mostly technology, but then you have things like Pepsi creeping in there a little bit. And there's some other things, but it's mainly technology. And it's, again, it's seen as fortresses of safety. And I love to invest in the QQQ, but I on a short-term basis, if the market explodes upwards, I will shift into TQQQ, which is triple the leverage of the QQQ. For every dollar that the QQQ goes up, you get $3 on the TQQQ. I made a lot of money last year when the market was a super bear. I made a lot of money on SQQQ. And I would not do SQQQ right now. I think it's premature to jump into that. I think unless something comes completely out of the air, I think we'll be given some warning that some major institution is ready to go down. And until I hear that news, and it has to be major, I would not go into SQQQ. My cat agrees with me. So I'm mainly playing the QQQ, which is the safer one to do. And the TQQQ, you have to be on that every minute. So only if you have the time to devote to every second of watching it, you don't do the TQQQ unless you can be on it every second, because again, it triples your gains, but it triples your losses too. So if there was a major event and it was a quick event, you could lose a lot of money. But I'm experienced enough with it that I feel comfortable doing this because I have a good sense of how it moves. If you want to invest in individual companies in the QQQ, the 100 largest companies on the NASDAQ, my next video I will feature which of the mega caps I would consider investing in. Right now I'm playing the QQQ and the TQQQ because I want to be able to get out of the market fast, and because I don't quite trust it yet. But I'm beginning to trust it, and I'm tiptoeing in, and I'm actively trading the QQQ and the TQQQ, which are ETFs. But to do individual companies, I got to see a sustained upward movement to where we feel like we're well past these bank problems. But in the next video, I will give you my best estimate of which mega caps are the safest and the most likely to make you money. That's all I have. Thank you. Be sure to smash the like button, subscribe if you haven't done that, and I will hope to see you in the next video.